Welcome to Financial Wizardry 101. Today, we will be talking about the fascinating world of call options, specifically how buying them can give you a unique edge in the market.
Hmm.
Imagine this scenario, one that pops up all the time. You're feeling pretty optimistic about a company, let's just call it TechCo Inc., for
Yeah.
simplicity.
Sure, TechCo.
You think it's a solid business, fundamentally sound, and its stock price, maybe hovering around, say, $27, looks like it's just hit a temporary low point. You're convinced it's going to bounce back, maybe significantly.
Right, you're bullish.
Exactly. But here's the rub. You're a bit nervous about just diving in and buying a whole load of shares right now.
Mm-hmm.
What if? What if it dips just a little bit further before it really takes off?
Uh-huh. The classic timing fear.
Yeah, you don't want to miss that big rebound when it happens, but you also, want to limit your risk if things go south unexpectedly in the short term.
That is a classic dilemma. I mean, really classic. And it perfectly sets the stage for why someone might look at using a call option. It lets you act on that bullish view, but with a kind of built-in safety net, a predetermined risk level.
Okay, so explain that. How does this call option actually work? What is it at its core?
Right. So at its heart, a call option gives you the right, and this is the crucial part,
Okay.
but not the obligation, to buy shares of something like our TechCo Inc. at a specific price. We call that the strike price.
Strike price. Got it.
And you have that right only up until a specific date in the future, which is the expiry date.
Right, not obligation. That seems really important.
It's everything, really. Because you have this right, you pay a small fee for it. It's called the premium.
Ah, the premium.
Yeah. Think of it like this. Imagine you want the option to buy a really nice house later at a set price. You might pay the owner a small, non-refundable deposit today to lock in that right.
Okay, like earnest money.
Sort of, yeah. If the house's value goes through the roof later, great. You exercise your option, buy it at the lower price you agreed on, and you've made money. But if the housing market tanks and the house is worth less, you just walk away. You lose your deposit, sure, but that's it. You don't lose the entire potential value difference of the house. That deposit, that premium, is your maximum risk.
Okay, that makes sense. So, back to TechCo Inc. Shares are trading around $27.
Right.
Let's say I decide to buy a call option, maybe with a strike price of $50.
Well, okay, $50 strike, so you're betting it'll go above that by expiry.
Right. And for this right, maybe I pay a premium of, let's keep it simple, say $7 per share covered by the option contract.
Okay, $7 premium. So that $7 immediately comes out of your account. That's your upfront cost, your skin in the game.
Got it. Cash outflow. All right, so let's walk through what could happen, how you could make money, or, well, not make money, assuming you hold this thing right until it expires.
Okay, to figure out the profit or loss at expiry, we need this concept called intrinsic value.
Intrinsic value.
For a call option, it's pretty simple. It's just how much the current stock price, the spot price at expiry, is above your strike price.
Oh, okay, the difference.
Exactly. If the stock price is at or below your strike price, the intrinsic value is just zero. You calculate it like max of either zero or the spot price minus the strike price.
Max zero spot strike.
Okay. So your overall profit or loss at expiry is then simply that intrinsic value minus the $7 premium you paid initially.
Intrinsic value minus premium. Okay, let's run some numbers for TechCo. We've got the $50 strike and the $7 premium.
Perfect. Let's start with scenario A. The spot price at expiry is below or maybe exactly at the strike price. So anywhere from, say, $19.90 up to $20.50.
Right. So what happens if TechCo finishes at like $20.30 or even right at $20.50?
Well, in that case, the intrinsic value is zero. Think about it. Why would you use your right to buy shares at $20.50 if the market price is $20.30 or even $20.50? You just wouldn't.
No, you just buy them cheaper or at the same price on the market. Makes sense.
Exactly. So the option expires worthless.
Okay, so if the intrinsic value is $0, what's my profit or loss?
It's zero minus the $7 premium you paid. So your P&L is negative $7, a loss of $7 per share.
A $7 loss.
But, and this is key, that $7 is the most you can possibly lose. Your loss is capped at the premium you paid. You knew that risk going in.
Okay, limited loss. That's the big draw for buying calls, right?
Absolutely. Defined risk. Now, let's look at scenario B. Spot price is above the strike, but maybe not by enough. This trips people up sometimes.
Oh, okay, this sounds interesting. What if the spot price at expiry is, say, $20.55? It's above our $20.50 strike.
Right. So now your option does have intrinsic value. It's $20.55 minus $20.50.
Which is $5.
So $5 intrinsic value. But wait, what was your total profit or loss? You have to subtract the premium.
Ah, right. So $5 intrinsic value minus the $7 premium I paid. That's still a loss, negative $2.
Exactly. You're above the strike price. The option is technically in the money, but you're still in the red overall.
So just getting past the strike isn't enough.
Not at all. You need the stock price to rise enough to cover that initial $7 premium cost before you actually start making a profit.
Okay, that makes perfect sense. Which brings us to, I guess, the point where you do cover the cost.
Right. Precisely. Scenario C. The break-even point. This is the magic number, the exact spot price at expiry where you neither make nor lose a dime.
All right. How do we figure that out?
Simple addition. For a call option, your break-even point is just your strike price plus the premium you paid.
Okay, so in our TECO example, $20.50 strike plus the $7 premium equals $20.57.
$20.57, that's your break-even. If TECO Inc. is trading at exactly $20.57 when your option expires, your intrinsic value is $7, $20.57, $20.50.
And $7 intrinsic value minus the $7 premium.
Equals zero. You're flat. No profit, no loss.
Okay, break-even achieved. Now for the fun part. Scenario D spot price is above the break-even point. So TECO goes above $20.57.
Yes, this is where you want it to be. If TECO's price climbs higher than $20.57, you start making money.
And how does that profit calculation work?
It's beautiful simple from here. For every single dollar the spot price rises above your $20.57 break-even point, your profit increases by exactly $1.
Dollar for dollar.
Dollar for dollar. So if the spot price hits, say, $20.60 at expiry, that's $3 above break-even. Your profit is $3 per share.
$20.60 spot, $20.50 strike, equal $10 intrinsic value. $10 $7 premium equals a $3 profit. Checks out. Okay.
If it really takes off and hits $20.70, that's $13 above break even, your profit jumps to $13 per share. $20.50 intrinsic, $27 equals $13 profit.
Wow. So once you cross that break even, the upside just keeps going.
Theoretically, yes. Your potential profit is unlimited because there's no theoretical limit to how high a stock price can go.
Okay. Unlimited potential gain, limited potential loss. That's the profile. Now, hang on. All these calculations, these scenarios, they assume we hold the option right until the expiry date.
That's right. We've been talking strictly about the P&L at expiry.
Is that what people usually do? Do they always wait?
Ah, good question. And the answer is overwhelmingly no. Here's something many newcomers don't grasp immediately. You don't have to hold the option until expiry.
You can trade the option itself.
Absolutely. The vast majority of people who buy options, especially shorter-term ones, aren't planning to hold them to expiry or ever actually exercise them to buy the shares.
Really? So what are they doing?
They're trading the premium. They buy the option contract when they think the premium is relatively low, maybe hoping the stock price will move favorably or volatility will increase, causing the premium to rise.
Ah, so they treat the option like a stock itself, in a way. Buy low, sell high.
Exactly. Let's say you buy that TECO call option when the premium is, say, $10. Then, maybe a few days or weeks later, things move your way, and the premium for that same option is now $12.
Okay.
You can just sell your option contract to someone else for $12. Your profit is simply the difference. $12 selling price minus $10 buying price equals a $2 profit per share.
And that's totally separate from the strike price or the break-even calculation.
Completely separate in that moment. You're just trading the value of the option contract itself. It's just like buying TECO stock for $10 and selling it for $12. The underlying mechanics involve things like time decay and volatility affecting the premium, but the trade itself is straightforward premium difference.
Wow, okay. So you can potentially profit just from the premium increasing, even if the stock hasn't actually crossed the break-even point needed for profit at expiry.
Precisely. This strategy is incredibly common. You can use tools just like with stocks, set stop-loss orders if the premium drops to cut your losses, set target orders to sell and lock in profits if the premium hits your goal.
You could even day trade these options, buy and sell the same call option multiple times in a day.
People certainly do. Just like trading shares, what matters in that context is simply the difference between your entry price, the premium you paid, and your exit price, the premium you received.
Okay, that adds a whole other dimension. So wrapping this up for you listening, someone interested in these markets, why really consider buying call options? What's the big picture advantage?
Well, it boils down to that powerful combination we talked about. Asymmetric payoff, your potential loss. Strictly limited. Capped at that premium you paid up front, defined risk.
Right, the $7 in our example.
But your potential gain, theoretically unlimited if the stock makes a big move upwards. It offers leverage a smaller amount of capital, the premium, controls the potential gains on a larger value of stock.
So it's a way to bet on that upside, that bullish view you have on TechCo, without having to shell out the full $2,000 plus per share to own it directly, and crucially, without risking that full amount if you're wrong.
Exactly. It's about capital efficiency and risk management. If TechCo unexpectedly went bankrupt, the stock owner loses everything. The call option buyer, they just lose their premium.
It sounds incredibly attractive, almost, too good to be true sometimes. Unlimited upside, fixed small loss. What's the catch? What's the trade-off? Someone's selling that option, right? What are they getting?
Excellent point. It's not free money. The seller of the call option takes the opposite side. They receive the premium, which is their maximum potential gain. But their potential loss is theoretically unlimited if the stock skyrockets because they're obligated to sell the shares at the lower strike price. So the buyer pays the premium for that limited, risk-unlimited reward profile. The cost, or the trade-off for the buyer, is primarily time decay.
Time decay.
Yeah. Options have a limited lifespan. As the expiry date gets closer, the time value part of the premium erodes, assuming everything else stays the same. It's like a melting ice cube. This decay works against the buyer and for the seller.
So you're not just betting on the price going up, you're betting it will go up fast enough to overcome that ticking clock of time decay.
Precisely. You need the stock to move sufficiently in your favor and often relatively quickly to make the trade profitable, especially if you're trading the premium itself before expiry. It adds that element of timing to your bet.
Fascinating. So it really is a tool for expressing a very specific view: direction, magnitude, and timing. It's about participating in potential upside while strictly defining your downside risk.
It is. So maybe consider how understanding this specific balance-limited risk, the potential for unlimited gain, but also the cost of time might change how you look at opportunities out there. It gives you more tools, more nuanced ways to engage with the market based on your specific forecast and risk tolerance.
That's all for today. Don't forget to like and stack more sats.